going. If you know me, I'm pretty laid back, so if you guys have questions, it's a smaller, intimate group, so feel free to raise your hand, ask one of the panelists a question, and let's have a good conversation tonight, all right? So let's start with Aaron. Why don't you just tell us about yourself, and we'll go down the line.
So Aaron Chapman, I'm a conventional lender, been in the space here since 1997. I do business nationally for real estate investors, buying single-family duplex, triplex, fourplex, up to your blanket loans and that kind of stuff. So that's where I focus my energy, my time. Interestingly enough, I don't do a ton in Arizona. So a lot of my stuff is in the South and Midwest, even though I live here, know a lot of people here, just all my buyers are going elsewhere. So,
Tina?
Hi, I'm Tina Tambor. I'm a local housing analyst with the Cromford Report. We do deep dives into the greater Phoenix housing market to see what's driving our prices and what concessions and things like that people, investors and sellers across the border pay.
Awesome, thank you. Sophia?
Hi, I'm Sophia Willits. I'm broker owner of Grace Erie, and I'm excited to talk about multifamily today. And I also created recently a course called Learning Apartments to teach people how to get on and off market properties with or without a broker.
Awesome. So let's start with you, Sophia. So how is you're in the multifamily world? So how has the multifamily business changed over the last year, and where do you see it going?
Great question. Now, a lot of people didn't recognize the patterns that we had the previous 10 years and then 10 years before that. But anyone who's actually purchased here in the last 3 years, 60% of them are underwater and most likely will lose their buildings.
Wow. So what do you foresee happening, and how are you taking advantage of that?
So the next 12 to 18 months is going to be the biggest transfer of wealth I actually see happening. A lot of people, I'll give an example. I sold a 96 unit in 2016 for $7 million, just actually right here in Mesa, right off of like Alma School Country Club in between, right here off of Southern. And flash forward, they sell it in 22, didn't touch the property, kept it like kind of like classic, semi-remodel, but not really. And they sold it for $27 million in 22.
Wow.
So they bought it for $285 a unit, and they went and put $30,000 a unit inside to renovate it. So now we're at like almost 320 something thousand a door, but Mesa has never traded for $320,000 a door. So now they're most likely going to lose an asset. They were originally collecting $1,535 in rent, and now they're collecting more like $1,250. And then it's also two-story construction, so like a lot of investors are like, we'll just go ahead and push people into these deals because, you know, we're represented by no one, because like the broker is an institutional broker, he only represents the seller. So these agents or syndication groups that come out of state and they don't know our market, don't know the cycles, they don't know the locations, they don't know what to look for.
Wow. So are you prepared to come? Can you come in, or you think there's some?
Yeah, so I'm going directly right now to syndication groups and seeing if they'll entertain a lower offer, basically what they currently owe. And then that can almost be a waste of time. You need to go directly right now to the funds managers and the banks and just go directly and see if they're willing to do potentially a short sale.
And Aaron, are you seeing anything in the lending world with multifamily, with that scenario?
not with that scenario, $300,000 a door, you're getting, did you say $1,200 a unit? And
Yeah,
what's the square feet per unit?
It was a majority, like, I would say 20% were ones, the rest were twos. It's just, there's so much competition on that street. I don't think people realize, hey, if you're buying a larger apartment complex and there's 10 more on your street, you're gonna be competing with your neighbor. Another problem is that, like, our wages haven't went up. So how can people keep on pushing these rents going up? So what's happened was, like, from just 2.5 years ago, like, I'm sorry, 22, like, I saw, like, there was like 7,800 evictions in like July of 22, so that was a red flag for me. And just last year, 23, we had 85,000, which is the largest since the early 2000s. And now, like, our vacancy from like 6%, like starting like 21, has now risen up to like 10 to 14%, just here alone, like in Tempe. And some parts of Phoenix is as high as 23%, and the rents have dropped about 25%.
I have a question for you.
Yeah, let's have a discussion.
I'm gonna be pulling out my 2005 brain now. What are the chances that they can convert those into individual units for sale?
Only if they were originally condo mapped. Now, there's have you ever seen Toll Brothers build like these mass communities for larger apartments? Well, they're condo mapped, so if anything ever happened, they could actually switch them over to be sold individually, but they originally have to be parceled to be that way.
I'm sure there's some people who can do that. You'll have to pull out some ancient agents from like 2005.
Condo conversion.
The condo conversion
Yeah,
thing.
so like, a lot of people didn't realize this, so like back in 2006, like everybody was buying everything and then like everything was lost, but a lot of people stopped paying their HOAs. So they passed this law like in, I think it was like in 2010 or something, where an investor could actually buy 80% of those condos and actually take over the HOA and then force sell everybody else out.
Yeah.
Great stuff. So let's jump over to Tina.
Yeah.
And as we all know, if you've been in investing for quite a few years, we're in a new Phoenix versus the old Phoenix. So what are some of the primary drivers that we're dealing with in today's market versus the past?
When you say the past, you mean like 2022?
Okay, thank you,
Which
Tina.
past? Before
I'll be coming into the
COVID?
calendar.
10 years ago.
Okay, that gives you some perspective. So from like 2014 then?
There you go.
Okay. So
December 2nd, 5 o'clock.
We were in a balanced market, there we were. And we are actually quite similar now to 2014 and 2015 in terms of seller market.
Okay.
We are very, very close to balance right now. So we're in this very, very mild seller market. It's not evenly distributed. It's mostly buyers markets in Pinal County and into Buckeye. And you're into only one balanced market right now, which is Litchfield Park, and then everybody else is sellers markets. But we have our top 5 seller markets are small. Believe it or not, Tolleson, El Mirage, those are the top 2. Then Chandler, then Glendale, Glendale, and then Apache Junction. So we're seeing more on the west side. So the West Valley cities are 3 of the top 5, and Southeast Valley are 2. And they're kind of on the outskirts. So what I'd say what we're seeing as a driver right now is new home construction. We don't have enough churn in the marketplace for resale to increase that supply line. So what we're seeing is that the builders are coming in and filling in that gap, and they're offering very large incentives because they tend to be in the buyers markets like Buckeye and Maricopa.
Cool. Anyone want to add anything?
So we have an influx of new construction that's been delivered because during COVID, a lot of the apartments couldn't finish construction. So we have 15,000 more units that are going to be scheduled to be delivered the end of this year. So like that's just going to be a little bit more competition. We have about 392,000 units available for rent right now in our state.
So there's more units coming on the market, but there's a bunch of units that are
Still available.
You're
Yeah,
talking about units for rent.
for rent.
Correct, yeah. All right, so Aaron, how does the lending environment nationally influence Phoenix?
Well, so what I'd seen since I've been dealing with real estate investors, first started coming into Phoenix in 2010 after the crash, started seeing the heavy deals that were available, buying up a lot of the real estate here. And then once they sucked it all up and the price points started to go up really quickly, they moved on. It was Indiana, Missouri, Texas, Tennessee, and started going from there. What I've noticed is that the real estate investors, at least that I work with, tend to really focus on that South and that Midwest, because that's where we're going to see those higher cash flow markets, those potential to get your cash flow on a monthly basis. Where an environment like where we're at, what you're describing, right? The cost for the door doesn't warrant what you're getting on a monthly basis. Getting that problem area until some of that does correct. So all I'm seeing is it's just going to draw people wherever they can make the return, and that's going to be. I'd imagine it changes what an investor want to come to the Arizona market for. And it's not going to be for every investor. There's going to be pushing a lot of them out. Others will come for so they can flip, they can purchase, they can get. Hopefully, it's going to turn the other direction. They come in and take something that's bleeding, turn it back around, or like you said, find a way to take an apartment complex, turn it into a condominium. But then we saw what happened in 2000 after the crash with condominiums, right? There's a lot of $1 million condos up in Scottsdale you couldn't sell for 100,000, right? There was crickets all over the place. So the market's I think the Arizona market is gonna dictate a lot what happens nationally, because people do look at a hybrid market like Arizona to see where things are gonna go. It's more of a barometer for the rest of the world than the world barometer for us.
Awesome. All right, anyone want to add anything on that?
Yeah, I do. The lenders, like pretty much, like 70% of all our lenders that were lending on apartments, like have left Arizona market. Like they saw it coming, they couldn't support the rent growth or like just basically what you're saying. So to get a deal actually financed right now for multifamily that's larger, the bank will need to offer an assumption such as like Fannie or Freddie offering those terms. The seller has to get creative financing in order to make these deals work. Otherwise, you're coming in with like 55 to 65% down.
Now, I'm thinking we're gonna be seeing more hedge funds coming in that don't really have a whole lot of accountability for where the capital's going to take over projects like that, even when it's overpriced, just to take control of the market. Now, let's think about this for a second. Hedge funds about 44% of the single families last year. They're looking to control potentially 60% of the single families by 2030 if this down this trajectory. That fits their profile because they're trying to turn this into basically a subscription-based economy. If you can hold that which will be subscribed to, which would be even overpriced apartments, they will be able to control markets, control what those rents will be, push those up and force people to pay higher even though they can't afford it.
Exactly.
So what's that mean to us in the room?
Buy now. You know, so I'm very concerned not about what I will live off of, what my retirement's gonna be like, because when I go to the grave, I'm coming in hot. I don't give a damn what I'm gonna be doing. But I'm worried about the next couple generations. Right now, our family trust will buy houses where my kids wanna live, and they'll lease back from the trust. Now, it's a trust I created, I'm not a trust fund baby. I come from the mines in northern New Mexico, so I got into this industry. And then it's the generation after that and the generation after that. I gotta worry about my great grandkids right now. Because if we don't worry about that now, they will be the subscribers. We have to acquire that which we can then subscribe out to other people. Let the hedge funds, let them push the markets so that we can benefit from that wave.
Awesome, great answer. So Tina, are there specific sectors within the Phoenix market, residential, that more promising than others for investors?
Well, it really depends on your risk tolerance, frankly. You've got a section of the market that is not interest rate sensitive at all, which is gonna be in luxury, mainly over 2 million, over 1.5 million. We're doing extremely well right there. However, that comes with some risk if you're gonna do short-term holds or flips or anything like that. I would say that the biggest opportunity comes right now in starter homes. And so I think you already saw where the builders are focusing on that, and they're trying to get some legislation through so they could, change up, narrow the streets, do whatever, smaller lots, but failed because firemen were like, we can't get our trucks through there, or something like that. But you can see already that they're realizing that the builders have been building larger homes for quite some time here, and so we have a shortage, if you will, of the smaller starter home that I would define as a 1,200 to 1,500 square foot, maybe 2 or 3 bedroom home. Or even, I think it would be nice to build some duplexes, things like that, things that are more affordable for entry level.
Got it. Cool. And Sophia, how about in the multifamily? Are you investing currently in Phoenix?
It just depends on what it is. Like I'm actually flipping in North Scottsdale homes.
Okay.
I flipped about 18 apartment buildings here in the last 2.5 years, but it was just for a short season. And I saw the season coming to an end, and now we opened up our brokerage also down in Florida. We're opening our 3rd location in Vegas. But Florida, I'm recognizing the same patterns I saw here like 4 to 6 years ago. So I can make this I'll buy a 4-plex and I'll make $400 to $1 million spread in 6 months. I used to do that here. Now I can take that investment and do the same thing now in Florida.
How much was that?
I make $400 to $1 million on little 4-plexes.
You got the course?
4 doors.
No, the course for sale.
I'm sorry?
The course.
Yeah, of course.
Show us how to do it.
Yes, I do teach that. Because my biggest thing is, I spent 22 months making that course is because I'm tired of the little guy not being looked at. I started with putting groceries on credit cards. I had had 2 small children and I was absolutely broke. I lost everything like in the early, or like the mid 2000s, lost everything. So like, I had to make something happen for myself, and the fastest way is to do small apartments. And the reason why I'm in my niche is because the 2 to 100 unit range actually trades every 18 months or less, or we'll trade the same asset 2 to 3 times a year. So it's the fastest trading asset in Arizona.
Wow. So Aaron, well, part of that, really, before I go there, is the little guy. I like how you said that, like with the iBuyers, the hedge funds, all this stuff. We're kind of getting pushed out, right? So I really want
like,
to draw.
I don't want the big guys to win. What about us? What legacies are we actually going to create for our children? Because like, I'll give you an example. I have my son, he wants $1,500 shoes, off-whites. And I'm like, dude, like, you gotta work for that. So I actually have it calling apartment owners. And he got a yes out of 10, and he's only 11 years old. But like, I'm teaching him now, and like, we're investing into his youth career. Like, we're spending $100,000 a year on his hockey training, and he's gonna play in Paris this summer, in Canada, and like, he's being recognized by all these people. But I'm like, dude, if you get like this NHL like contract, right? They're gonna take 40 to 50%, all the taxes. I'm like, I wanna set him up to be able to have an amazing career, but also be an investor at the same time. So that way he doesn't have to depend if he has an injury, because like, you can literally get killed in that game, so.
I bet you weren't thinking you were gonna say that when you were getting groceries in your credit card, huh?
No,
That's damn awesome. I mean, you guys gotta give her a round of applause. Say those kind of things here after that kind of a meeting, that's awesome. And I'll just tell you, the best way to get ahead is take your beating, learn from your beating, and move forward from your beating. Don't just lay there and lose.
And a lot of what I'm hearing in the conversations, and especially here today, is like, just buy now. Usually the thought was always, is the market going to go down, or rent's going to go down, is it going to go up, interest rates, you're always worried. But it seems like we're in a dynamic that's like, you just got to buy, even for your family, for your future, your legacy, or just to get in the game now. I don't even hear anyone talking about crashes. There are the doom and gloomers, but what are your thoughts? Just buying now, Tina.
I'm always a proponent of long-term holds, and so anything that is happening today, nothing is forever, so if you can hold a property without having to worry about it for a while, you know, as long as it's paying for itself, or as long as you can handle where it's at, I'd say I don't see a problem with holding real estate personally. I think most of the risk comes in the short term, and frankly, I believe that the hedge funds and the iBuyers, are there anybody here? They're dumb. They're just dumb. Well, you talk about the little guy's been running circles around these iBuyers and basically eating them for lunch, essentially. Because as you can see, I think Open lost another $91 million last quarter.
Wow.
That was the headline, and they thought that was great because it wasn't $1 billion. So they lost $1 billion in 2022. So I believe that, I don't think it's a good idea to have too much of the hedge fund activity either. I think it'd be better to have the little guys owning that type of real estate for basically hedging the risk that they have for long-term retirement and things like that.
So you're with the Cromford Report. So me, when I got started in real estate, I was like, when you see these charts, 30 minutes, 45 minutes, and all these lines, to me it was overwhelming and I didn't understand it, right? Yeah. So I know a lot of new people may shy away from that, but can you just explain to everyone how important a market update is that you, but it's a lot of information.
Yeah.
I remember one year, it was years ago, you said, you were talking about how this was when single families were like it's like 150, 200, and people were going, they're leaving, fixers and flippers were leaving the single families and going to townhouses. So once that was said, I was like, okay, so everyone's gonna shift all the end buyers into condos. So I switched up all my marketing, and then I did 3 deals in the next 2 months. Just off your information, can you explain how important the Cromford Report is for everybody to always pay attention to, even if you're not interested?
Well, I think that when you think about who my audience typically is, it's the residential real estate population. And they're ADHD like me, so I get them. And the thing is that most of them, a lot of them are not chart people, they're not analysts. But since COVID, nothing like a good crisis to make everybody pay attention. Since COVID, people coming to the presentations every week, they find themselves now rattling off statistics that they never thought they would. have. And so I have a system now where I just show the same chart so you can see the progression week over week or month over month, however often they're coming. And they gradually get proficient. It's not about understanding the entire hour and a half Zoom in one sitting. It's about, okay, I'm gonna learn this part first, and then all the rest starts to fall into place. The more you start to see it, and the puzzle starts to look like a picture. Does that make sense? So I believe that the statistics show opportunity in every market, whether you're in a down market or up market, there's always somebody making money. And once you recognize the impact of Wall Street coming into the market, pushing up prices, you get to understand the timing of things and when to get in and when to get out. And, I think that over time, it starts to give you kind of a roadmap, or at least headlights. I like to say, we don't know what's going on down the road, but we don't want to be driving in the dark. We just let you know when there's a curve in the road.
Perfect, thank you. Appreciate everything you do. Aaron, interest rates, where are they at for investors?
Or are they, as in what would an investor pay right now?
What would they pay? And we heard some headlines that there may be no cuts coming, or there wasn't plans to cut from the Fed.
So where they are right now, if you're a regular real estate investor just buying a single family house, which I believe the way that hedge funds are playing, that could become, this is just an opinion, our most valuable per square foot real estate on the planet because of what their intentions are. Now, if you're a real estate investor, you're just buying, trying to get a 30-year fixed on it for 20% down, you're talking about 7.6% with maybe a point, maybe two. If you look at bankrate.com, it's about 7.1, 7.2% right now. A lot of people are talking about, well, when the rates go down, we're gonna be back to the fives again. Well, I completely disagree with that. If you're gonna be here tomorrow at 2 o'clock, I'll show you on these big ass screens why I disagree and what the charts reflect and why I think that they are completely in error with that. What people were hoping for was 4 rate cuts. Then it's 3. Well, now maybe it's only gonna be 2. I don't think there's gonna be any. Why? Because we all are familiar with inflation. We got really, really familiar with inflation after the current administration took control of things, started turning things loose. And I don't think it's completely controlled by administration, but when you dick up enough things get inflated, right? You shut down a country, you shut down people's ability to make money, things get very, very inflated. Well, because of that, if you can't keep inflation under control by pushing up the cost of money, then you have to keep that cost of money high, which is what the Fed is doing. The problem we have is we've created a dopamine-loving society that can't help but click buy on the damn Amazon app. The more money they spend, the more they keep the cost of goods up. And because we can't stop spending, I don't know about you guys, but I might as well just buy a damn Amazon truck. It stays at my house. And what's amazing is how much shit stays in the box on the table for like a week. You need it that damn bad that you need to buy it, but it stays sitting on my damn table, right? That is a problem that we have in our country, and that's going to keep inflation high. Because inflation is going to continue to stay high, what's funny is they keep cooking the books. You guys keep looking at jobless claims, looking at other data. They keep showing us what it is, and then on the back page, it will then revise last month's data. Because it's now not a big headline mover. As long as they keep playing that game, inflation is going to keep riding high. And inflation numbers are given us already cooked. It's in the teens. It's not 4%. Because of that, they can't drop those rates. Because if they drop those rates, what are people going to do? They're going to buy more crap. They're going to push the cost of things up. The only reason they've dropped rates right now, as far as the federal fund rate, which doesn't directly correlate to your mortgage rates, we'll get into tomorrow as to what drives mortgage rates. The only reason they've dropped rates, I believe, this year is politically. It has nothing to do economically.
Any thoughts, Tina, on rates and inflation in your world?
Don't even get me started on the CPI.
Let's get started.
I need my own slide deck for that.
I'll get into that tomorrow too.
Yeah. So I've been watching the inversion. So one of the things I've learned about the Fed funds rate is that they don't instigate change, they respond to it. So when they finally decide if they're gonna do a decline in the Fed funds rate, we will have already seen our market shift. We will have already seen changes in the bond market. We will probably have already seen the inversion correct, with the 2-year bond and the 10-year treasury. It is now officially the longest inversion in history.
And it's the deepest inversion in
And
history.
the deepest, and they are getting closer together, but what's gonna cause that two-year bond to go back where it belongs below the 10-year treasury, which is really, I think, what they're looking to see, because every time that happens, that's when they reduce the funds rate. It's most likely gonna be unemployment. So, now you're still gonna see a lot of discussion, recession, no recession, whatever it is. For us in the housing market, we don't care. We've been through this 2-year-long, our own recession, if you will. I don't think they can shoot anything else at us, frankly. Like, what else you got? We've been running this marathon forever. And so I believe as the housing market as a whole is running just basically waiting. We're just in a holding pattern. We're in a holding pattern. Our median price has not moved in about almost a year. So it hasn't gone, on the MLS anyway, we've been hovering between 445 and 435 since May of last year. So prices have not been fluctuating despite rates going from 6.6 to 7 to 8, back down to 6.6, back up to 7. It's been all over the place, and we've been staying at the same rate. And we're still suppressed in our demand, and if we start to see the rates glide down, we will start to see the beginning of the recovery of housing. And so when it comes to buying, it's a good time to be an owner when that happens. So it's always a good idea if you have the ability to buy whenever people are scared, understand, where we're at in the cycle. I believe we're pretty much at the base of buyers right now.
So it's really a good time to buy. Is anyone here not on a rental property? So we're all pretty much owners, one, two, couple? Yeah, so I think we're in a great time to start buying. You said it starts recovering even better, so.
Yeah.
Any questions?
I have a question for Tina.
Mike.
So I saw the CMIs around about 113 right now.
CPI?
The CMI.
Oh, the CMI, yes, sorry.
So a balanced CMI is about 110, is that correct?
Between 90 and 110.
And so are you saying right now, because it's kind of a balanced market, are you saying right now that you're seeing things trending towards buyers, sellers, or you're just saying that it's totally stabilized?
It's hanging out. It's really not doing much. We're just above a balanced market, but we're not evenly distributed throughout the valley. Okay, so you've got your interior cities are all sellers markets. Okay, and your exterior cities like Buckeye, Maricopa, Casa Grande, Gold Canyon, Queen Creek, all of those are in buyers markets right now. And a lot of those are where a lot of the new homes are, because the new homes are adding to supply, and that tends to depress the market. It keeps your prices from moving up too much. We're not seeing any price declines though. We're seeing mostly either flat or barely rising. And there's a big difference between the market of homes that are on the smaller side, like under 2,500 square feet versus over 2,500 square feet. Okay, once you get under 2,500, you're looking at an appreciation rate per square foot of like 5 to 6%. But then you get into the luxury and pre-luxury, you're looking at 8. So what we're seeing is a lot of our appreciation is being pushed up by the luxury market right now, because this is our peak luxury season, and we are seeing now just as many sales over 1 million as we did in 2021, and somewhere around the 2021 to 2022.
So if it's stabilizing, then I think things could become more predictable, right? So it sounds like it might be even better to jump into some deals. So are you noticing any difference on the fix and flip market?
Fix and flips are depressed. I mean, we're not seeing as many, meaning that they're being a lot pickier, which they should be. And in this type of market, you don't wanna overpay and you don't wanna over-improve. You don't wanna be saying, hey, my goal is to set the record for this neighborhood. You wanna make sure that you're the nicest home at a mid-range price to sell fast. So you have to really buffer your acquisition prices quite a bit, and of course that means that in our numbers, the people who are acquiring and selling within a 6-month period are pretty similar to those in 2014 and 15.
Got it. And Sophia, you're flipping a luxury property right now, right?
Yeah, in the DC ranch, so I was able to pick up this property. Agent didn't take very nice pictures. I was able to pick it up for the same price he bought it for in 2020. He owed some taxes, and then I also did a seller carryback around the existing note. No prepaid, no balloon, none of that. And like it made it a lot more easy to get into and start the full renovation. But like luxury, like if you're looking at DC ranch, there's like over 5,000 homes, right? But if you can take a 3-bedroom 2.25 bath and make it a 5 full 3, then it's going to attract the home buyer that actually has a family, because who wants to spend like over $1 million and live in a 3, 2.5? Like really, it's not like it's functioning obsolescent now. So you have to make it to like today's standard.
So are you doing like value adds or any square
Yeah,
footage?
I added 2 extra bedrooms, added a full bath, and like I bought it for 125, like in November of 23. So my exit price is going to be like 2.1.
Wow, so Tina, are there any permitting stats you can give us, like
Yeah.
Yeah, just what do we have?
Permits are up. January was the second largest month for permits since going back to 2012 on my chart. So you've got 2021 and then 22 were very high, and then we saw a big drop in January of 2023. This time 24 is back up to that 21 level. And so, and we've been seeing every month for about 7 months a gradual increase in those permits. The news media is still reporting on a decline in permits. They're always behind. So our permits are already rising. Also, we're seeing in terms of new home sales, January sales were just as high again as 2020, 2021.
Got it. Any questions, follow-up questions?
I have a quick one real quick here. What are we seeing as far as your rehab costs, your cost of materials and labor? Is that going up, going down? How's that?
Depends if you're using someone that's licensed and getting permits. I normally don't use someone that's licensed, but I did use London Pierce. She seems to be really good and excellent. She's up in North Scottsdale. She's a designer. She's also a realtor, but she has like her own furniture store, her own design center, and without her, I don't think I could sell this property for 2.1. Because everyone does like kind of that lipstick flip. They put in like some laminate floors and quartz countertops that you see everywhere, but this remodel is going to look like a $10 million remodel in like a $2 million price point. So like if you can change the floor plan, change it to be like what you see like in like DC of like it's a Silverleaf of Arcadia or some of those $30-40 million homes up in DC Ranch. If you can make it look like one of those in like the tract homes, like they'll sell like hotcakes.
So, any questions out here for these experts? No, everyone's pretty laid back. All right, cool. So, what else we got here? So, Aaron, any what financing advice do you have for Phoenix investors? Based on national lending trends and understanding the market.
So when it comes to Phoenix right now, it's like we were saying, kind of watch and see where it's going to go. It's not necessarily as all of it about. If you're a real estate investor, you want to purchase something that you're going to be able to. I always tell everybody, yeah, sure, you want to be able to cash flow, but too often our last 13 years, everybody got so wrapped up in cash on cash return that they weren't looking at all the other metrics. And so because of that, those goggles that you have on, the average real estate investor is going to look at the bottom line and say, what's my cash on cash? They're going to ignore all those other things. I'm going to talk a little bit more about that tomorrow, where they should be focused, or what they miss if they're just focusing on that because of the risk that they're going to have. What a person should be doing is kind of look around and see what other opportunities are out there. Right? There are other markets that are doing very, very well that a person can get into, purchase, and be able to be confident with what they're building in their portfolio, and keep an eye on the Phoenix market. Right, so I deal with a lot of the South and the Midwest. We got deals going on, brand new builds. Presently right now, I'm not trying to do a sales pitch, but I'm working with people out there building houses that already tenanted, brand new builds, and they're, instead of using their marketing dollars to buy more advertising, they're using just to funnel through me to get an interest rate for people that they will cash flow immediately. So otherwise, at today's rates, they wouldn't. So that way, they can at least feel better about the acquisition and continue to build on that long-term product that they're looking at. So you get a 30-year fixed at 5.99% and 0 points, you're dumb not to, right? Not that I think interest rates is all about. So I just tell the Phoenix investor, you're gonna see opportunities here. I think they're coming fast. But if you need to do something with your capital right now, you need to continue to add to your portfolio while you're waiting, there's places out there. Poke your head up and look around.
Do you have something to add?
Yeah, I think that a lot of the headlines that I've been seeing about the long-term investment that our cities are doing in terms of jobs and corporations coming here are going to be very important for those long-term plans that you talk about. Similar to like for instance, Phoenix Business Journal reported a 2,000 acre tech park that they're planning for Buckeye. So that would completely transform that Buckeye area over the next 10, 15 years. So if you buy a property and now Buckeye's in a buyer's market, you can get some pretty good incentives and you can hold it for a long time and grow that neighborhood. And when you look at that, just think of how those types of opportunities transformed Chandler and Gilbert over the last 20 years. I mean, I took a signing out in Gilbert in 2001, it was nothing but flies and a stop sign. You know, I mean, that place was just all farmland. So just seeing the transformation that can happen to a city in my career, frankly, is pretty overwhelming when you think about it. So areas like Buckeye, areas like Peoria, where you've got Amcor's going in there, that's gonna have 2,000 employees going right at the front doorstep of Estancia, right off the 303. You're looking at the development of another employment center, employment corridor coming in off of the 303, and then, you know, all the way down to the 10 between the 101 and that 303 area, and then pushing into Buckeye. So that means that the opportunities that we have today to acquire a property and wait for that area to kind of mold and develop into what it's going to be is probably one of the best opportunities for long-term investment, in my opinion.
And that's pretty interesting because in Arizona, I think historically, it kind of grew from the outside, where most cities grow from the center out, right? We grow in the suburbs. And I think after the Great Recession, everyone kind of came back into the city. And it's always been kind of frowned upon as an investor to go on the outskirts again. So now we're kind of hearing that that's not an issue right now.
Well, maybe it won't be the outskirts, you know,
Yeah.
I've seen conversations people have online, you know, I answer
The real
every
message.
week, you know, where you'll hear somebody say, oh, I bought my home in Ahwatukee in the 1990s, and somebody else say, you were so lucky, it was only 100,000, or it was only 200,000. There was nobody in Ahwatukee in 1995. It was the outskirts. Now it's considered an internal part of the city. And so that's what we're kind of talking about, is that some of these areas like Buckeye, like Peoria, like Santan Valley, and you know, Gold Canyon and all those areas, Apache Junction, they're probably gonna look completely different in the next 10 to 15 years. So if you have a long-term plan or you're strategic about where you acquire your properties, it may feel like it's on the outskirts today, but maybe not over the next few years.
I almost feel like it won't be long, we'll be walking rooftops of Tucson. So you're
We're
right,
not trained.
understand what the municipalities are attempting to do, what they're bringing in, read her report, and start making decisions for yourself. And don't get pushed around by what the market's doing on a macro level. Don't let interest rates, don't let what the news is trying to say push you around. Dig into your areas that you have interest in, understand them.
Yeah, and a mentor always say, follow the sewer lines, right? So all these big, I think I was over on like 300th Ave by Buckeye or whatever it is a couple weeks ago. It's just, everything's fully grown, apartment complexes, communities, businesses. So we're growing. So that leads me to say, like, what about like Eloy, Casa Grande? Are you doing any research down there, Tina?
Me?
Yeah.
I mean, I've been watching it.
Okay.
I wouldn't say I've gone deep into Eloy, but Eloy's kind of like right there in between Tucson. It's kind of on the edge. I can't tell if they're being affected by our market or Tucson's market. You know, and I don't track Tucson. But Casa Grande's been kind of like this. They're hot, then they're not. They're hot, then they're not. You know what I mean? So I think Casa Grande for me doesn't. This is just my personal opinion now, because I'm not into Casa Grande, but I kind of feel like if it were me, I'd be moving more towards Maricopa.
Got it.
You know, that's just me, but I think Casa Grande has a lot of potential going on in there. Once a lot of these companies are moving, these plants are moving out there. Coolidge has Procter & Gamble that's gonna be hiring like 600 people for that.
Yeah.
And you've got a number of the suppliers for Taiwan Semiconductor going down to Pinal County because it's less expensive. So a lot of that is just long-term stuff. I just feel that feels a little longer to me.
And the train's coming, potentially?
Yeah, somebody
Tucson,
said
Phoenix.
we're gonna get a train. Remember, the federal government was like transportation, and somebody was like train. And I'm like, train from Tucson to Phoenix, that sounds good to me.
So Sophia, what about yourself? Would you look at multifamily investments in Casa Grande, Eloy, Coolidge?
No,
No?
no, never.
Reason why?
Tucson is always a few years behind, like, the market, like, I would look in Tucson for multifamily, but not Eloy or Casa Grande's markets are, you know, not the best.
Far out.
Yeah, I mean, I like Sierra Vista, I can tell you that.
Why Sierra Vista?
Because you can pick up units for a really good price and still actually make a really good cap rate, and it's just beautiful down there. It's actually like 15 to 20 degrees cooler than Tucson. So like, you're not as much competition for the student housing. Some of the prices in Tucson have been overly inflated, but they're starting to come back down again.
Got it. Everyone familiar with Sierra Vista?
Is there mine there?
It's a great place.
It's beautiful.
It's like a military town, right?
Yeah, it is.
Yeah.
It's not a huge, like, I think it's like the Hookah Chuka or something. Babe, do you know what it is?
Fort Huachuca?
Yeah,
Is that what you're
Fort Huachuca? Yeah, something like that.
The air,
So we
I
got
thought you were talking about a smoking instrument.
Yeah. Military.
cool. So we got 2 minutes left. So I want to make sure if you guys have any burning questions or any thoughts about the market, you have a wealth of information right here on stage I would take advantage of. So any final questions before we wrap up? Yes.
I have a question about permits. Is there a way to get expedited permits?
Is there
A lot of grease, you gotta know somebody.
Yeah, that is so true to that.
Good question. Like, is there any? Do you guys know any time frames on permits and how they're running right now?
I never do permits.
Never do permits. Okay.
I did once on one apartment building
Never
for,
again.
yeah, no, we did it for new electrical, so it takes like 2 to 3 months to get through the process. And then you need an engineer as well.
And you gotta get somebody who really knows what they're doing when they're completing the paperwork. Don't take it upon yourself, because you're gonna find that you're gonna go back and forth, back and forth, back and forth, because you're gonna miss something, and you're gonna eat up all your potential profitability in the market just to try to get those damn permits. Find people who are very good at it, know what they're doing, can go behind the counter, and somebody to stamp it. That's how you know who can do that for you.
Awesome. All right. Well, no other final questions? That will wrap up our Phoenix market update. Do you guys have any final last thoughts you can share with everybody?
See you guys tomorrow.
See you tomorrow. Yeah, Monday, April 8th at venue 8600. We'll actually have Tina and Aaron on the panel for fair housing as well. And Tina will be doing a market update. But it sounds like, to wrap it up, buy the property right, buy now, long-term hold, you won't go wrong in Phoenix.
Just buy it.
Yep.
Seriously. Set your baselines, make sure it fits the baselines, and never go outside of them.
Cool. All right, thank you, everybody. Thank you.